the people that are trading 5,000 ounce bars here and there, big banks or family offices or billionaires, they're not going to tell us what they're doing. They're not going to interview about it. It's not going to be on the mainstream media. So whatever is happening in the silver market is happening at the much bigger wholesale level than a few people that are, digging up some silverware and sending it to their local coin shop and getting rejected.
Yeah, yeah.
Throughout the United States, they have extra silver somewhere. They have silverware. They have whatever cups or whatever heirlooms that they might, and they're trying to sell it. They're trying to dump it in coin shops, and a lot of them are refusing to take silver because they can't pass it along to the refiners to melt down because there's a clog somewhere. So there are a lot of willing sellers, but the refiners are filled. They can't handle any more products. So there's some kind of disjointing here, and the question is who's bidding the price up.
According to precious metals researcher Rafi Farber, most people are unaware of the deeper tale that lies beyond the headlines of inflation statistics and central bank policy. Rafi claims that there are indications of systemic stress and covert manipulation in the gold and silver markets. He shows that governments have historically used gold confiscation as a last resort to keep control over credit, stifle free markets, and extend the duration of inflation whenever the monetary system reached its breaking point. However, Rafi contends that no matter how strong the state grows, this control always crumbles and gold finally regains its status as actual money, the cornerstone of confidence in a deteriorating system of fiat promises. Rafi cautions that there are fractures in the silver market that few people are discussing. Supply chains are clogged, refiners are overworked, and even while there is an abundance of physical silver, it is being stuck in the system and cannot get to the market quickly enough. If you want more content on precious metals investing, be sure to like, subscribe, and click the bell.
Well, you confiscate gold to control credit because if money is centralized, then you have more control over the credit until it doesn't work anymore. So it just extends the life of inflation. But I find it very encouraging that there's a campaign on X against gold buy crypto because that means that they care about this and they're worried about it.
I
That
know.
reveals a lot. Yeah, but that's not really a crime. The
No,
Yeah, so insider trading, it's perceived as a crime, but it's not,
yeah.
it shouldn't be a crime, and it's not actually a crime.
It never
Um,
used to be, Rafi. Yeah, sorry, go ahead.
yeah, yeah. So I mean, this is a big libertarian point that if insider trade, if we stop prosecuting for insider trading, then people can look at actual moves and then the information filters down. I mean, you're never going to get rid of the advantage that the rich have if they have more money to move the markets, and they usually have the information first because they're more well connected in the business world. I mean, there's no such thing as fair information or telling everyone all at the same time unless nobody has any privacy with anything they say. So there's no reason to prosecute anyone for any insider trading. It's fine. And the less we prosecute it, the less valuable it will be. Because now when somebody really gets away with it, he makes a lot of money. Yeah, I don't want to make predictions on exactly how it's going to look, because I honestly I don't know. I mean, I try to think that it's going to be more positive than negative because I see the world we're in now and I see the trajectory that it's taking because of the inflation. So I'd rather not go to where they want to take us, which is complete surveillance, complete state power. Everybody's signing up to WHO treaties so that the next medical event, whatever it may be or not, then we're all put in concentration camps. That's what they wanted to do last time. That's what they're trying to do now. So I don't want to be there. So any other alternative is better. So let's go through a little bit of hardship maybe, and maybe the weak are going to have trouble, and those who don't have actual money are going to be in trouble. But it's going to be better for them to be in trouble now than for them to be in a camp because of some cold that escapes some lab in a year or two or whatever they're planning up. I don't know, some kind of permutation of that. So I'm glad to not be on the road that they want me to be on. Throughout the United States, they have extra silver somewhere. They have silverware. They have whatever cups or whatever heirlooms that they might, and they're trying to sell it. They're trying to dump it in coin shops, and a lot of them are refusing to take silver because they can't pass it along to the refiners to melt down because there's a clog somewhere. So there are a lot of willing sellers, but the refiners are filled. They can't handle any more products. So there's some kind of disjointing here, and And the question is, who's bidding the price up? If they
Yeah.
can't get the silver, the people willing to sell it, then what happens from here? I mean,
Yeah.
this is one of the symptoms of the fact that silver demand can come back into the public consciousness so quickly that the market, as it's structured for these current prices, can't handle where we are now, and then it results in a clog. That's what's happening.
Yeah.
And how much of the market really is that? I don't think it's that much. It's just the part that we see because it's the sector of the market that we're the most interested in and that we're a part of. And so we hear more about that. But like the people that are trading 5,000 ounce bars here and there, big banks or family offices or billionaires, they're not going to tell us what they're doing. They're not going to interview about it. It's not going to be on the mainstream media. So whatever is happening in the silver market is happening at the much bigger wholesale level than a few people that are, digging up some silver and sending it to their local coin shop and getting rejected.
Yeah. Yeah.
Okay, well, the latest is we're still over 100%, meaning there are more repo trades being made every night. I think the last number was it was over 3 trillion. Then there are reserves that exist in the banking system. I think that's 2.98 or 2.88 trillion. Whatever it is, there's more volume being traded every night than reserves that exist. Now, I've been looking into reasons how this is possible, and the closest I can get to an answer is that there's central clearing. So if two parties are trading, or a circle of parties are trading repo to each other, and you have a central clearing mechanism that cancels out repo debts from one bank to another, and so if one bank owes 50 billion and then the other bank owes them 70 billion back, only 20 billion will actually change hands, whereas 120 billion will be recorded as trading volume. I don't know how much of the volume is cleared, but what I can say is that I don't think there's that much room left, because we still see the repo rate getting squeezed higher. I think the last one was 4.3, and the Fed's upper bound is 4.25. So we're already out of the Fed's range, and that has to do with corporate tax day that was on October 15th. And on corporate tax day, a lot of money gets sucked into the treasury, so there's fewer dollars to trade in the repo market. But we wouldn't be trading above the Fed's upper target if the repo market weren't already tight. How tight can it get? Can we get to 110, 120%? Maybe, but we're close to something bad. It's just going to take a little bit more time than I thought.
Rafi Farber makes a convincing connection between the strengthening of precious metals and the increasing strain on the financial system. He cites the repo market, the overnight lending mechanism used by banks to maintain liquidity, as a key red flag. Rates are already beginning to rise over the Fed's upper limit, and nightly repo trades are now surpassing available reserves, indicating that liquidity is drying up and pressure is growing beneath the surface. Given the current climate, gold's sustained surge over $4,000 supports his theory that investors are looking for protection as the fissures in fiat markets expand. Farber quickly clarifies, though, that this is not a recurrence of the 2011 cycle. The gold to silver ratio dropped to 30-1 at that time due to a sharp increase in silver. This time, the ratio is closer to 80-1, and both metals are rising gradually together, indicating healthier and more sustainable growth. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
Well, that would mean that there's not enough money to borrow between the banks.
Yeah.
The repo is a standard feature of the Fed's daily monetary activities before COVID, and it was much more than $6 or $8 billion a day. So it's still not that much, but I remember reading a few articles explaining why the standing repo facility can't help most banks. I forgot what the technical reasons are, but you have to be a certain type of bank to be able to use the standing repo facility. So if you're like if you're like a regional bank that doesn't have direct access to the Fed because you're too small, then the standing repo facility is not going to help you. But it's DAFCA, specifically the smaller regional banks that would have the most trouble, and they need the most access to the Fed, but they specifically don't have it. So the standing repo facility is pretty useless in saving smaller banks, which could start a chain reaction. So really, the standing repo facility is irrelevant. It doesn't even matter. That's good. Birch Gold, though, has a lot of shady dealings in numismatics. So sometimes they try to upsell people to the fake numismatic coins. Not exactly that they're fake, but I think Andy Shechtman told me basically how it works. Like you buy a die, and it's an exclusive sort of coin, and then you have the rights to the die. So then you stamp like a limited amount of this limited edition coin that supposedly has numismatic value, but it's not old or anything, and it's not even official. It's just a die that you happen to buy from some die maker, and then you just pump up the premiums that way. I've even gotten some calls in Israel from people that I like, people that are also believe in sound money. They're like, Rafi, do you want to participate in this thing? There's this company in Ethiopia that's making these gold medallions for $11,000 an ounce. I'm like, no, I don't want to be any part of that. No,
No.
it will, especially when we get to the panic phase, which is why I don't think we're over with this rally yet. We could pause for a month or two or three or whatever it's going to be.
Yeah.
But I don't think this is the top, and then we're gonna fall down like we did in 2011, and then another 4-year bear market, and then it took us another 5, 6,
Yeah.
7 years to go. I don't think that's where we are because so the gold to silver ratio hasn't gotten anywhere near 40 to 1, let alone 30 or 15. In 2011, the gold to silver ratio was plummeting as silver made a final high in April, May 2011 to $50 then. But then the gold to silver ratio went down to about 30 to 1 now. And we're not seeing any of that. We're seeing both gold and silver pretty much go vertical almost at the same pace. Silver's going a little bit faster, but not noticeably faster.
According to Rafi Farber, the repo market, an overnight lending arrangement that enables banks to borrow money by pledging assets, is making the increasing tension in the financial system evident. According to him, a significant increase in repo activity indicates a lack of liquidity or insufficient money flowing between banks. Farber pointed out that although the Fed does have a standing repo facility designed to offer cash support, this arrangement primarily benefits big primary banks that have direct access to the Fed. Farber also discussed questionable strategies in the gold market, cautioning investors about businesses that take advantage of fear by charging exorbitant prices for so-called limited edition numismatic coins. He clarified that these coins are only a marketing ploy to charge exorbitant fees and frequently have little actual worth because they are neither rare nor historic. Instead of being duped by hype, he counseled investors to concentrate on actual physical gold and silver. Farber is certain that the boom in the metals market is still going strong. Today's market appears more balanced than it did in 2011, when silver shot up to roughly $50 and the gold to silver ratio fell to 30 to 1 before plummeting. Together, gold and silver are increasing steadily, keeping their ratio closer to 80 to 1, which indicates that this increase is more sustainable and not a blow-off peak. Additionally, he highlighted a crucial technical indicator. Open interest actually rose during the most recent decline. In his final remarks, Farber reminded the audience that gold and silver are lifelines of capital in a real crisis, not merely investments. Hard money holders will have the chance and obligation to restore real value if the financial system collapses and the value of assets declines. Thanks for watching. Be sure to like, subscribe, and ring the bell for the latest gold and silver updates.